When the draft BSEC IPO Rules 2025 were first released, they triggered widespread concern among issuers, investors, and market intermediaries. While the intent was stronger regulation, several provisions were viewed as overly rigid, particularly around capital requirements, pricing mechanisms, and the use of IPO proceeds. This is Tahmina Jahan, an analyst at Lion City Advisory. The final rules bring much-needed calibration. A minimum post-IPO paid-up capital of 50 crore taka has now been introduced, providing clarity over the draft. Under the fixed price method, share can now be issued at both premium and discount. Importantly, for large issuers with pre-IPO paid-up capital of 500 crore taka or more, dilution is capped at 5 to 10%, allowing substantial capital raising without excessive erosion of control. This provision is particularly beneficial for large unlisted telecom operators where capital needs are high but ownership dilution is sensitive, and for institutions such as Sammilito Islami Bank PLC where balance sheet size is significant and gradual market entry is preferable. Moreover, in case of oversubscription, equity securities will be allotted on lottery basis to the general investors and non-resident Bangladeshis under both fixed price and book building method. One of the most important changes concerns the use of IPO proceeds. While the draft rules prohibited loan repayment entirely, the final rules allow up to 30% of IPO funds to be used for debt repayment. This reflects practical balance sheet realities faced by issuers. To maintain oversight, issuers are now required to submit quarterly reports to BSEC detailing proceeds utilization. The allotment framework has also been significantly restructured. Under the fixed price method, eligible investors now receive 10% of the issue, down from 30% in the draft, while general investors receive 60%. Retail allocation under book building has also increased, and any undersubscription by eligible investors automatically flows to general investors, reducing execution risk. Equally important is the redesign of the eligible investor lock-in. Instead of a blanket 180-day lock-in, the final rules introduce a staggered structure. 50% of EI allotted shares are locked in for 90 days, 25% for 120 days, and the remaining 25% for 180 days. This phased release improves post-listing liquidity while still preventing early market distortion. Additionally, strategic investors have a lock-in for 2 years from the date of the investment or 1 year from the trading day. Lion City Advisory supports issuers and investors by guiding them through IPO structuring, valuation under the revised IPO framework, proceeds utilization planning, staggered implications, and regulatory timelines. By aligning regulatory compliance with market expectations, Lion City Advisory helps ensure IPOs are not only rule compliant but also efficiently priced, well subscribed, and sustainable in the secondary market. That's all for today. Keep in touch with us for more such insights.